Continuing with topic 2 of paper 9, we're now going to look at section 5 on option trading strategies. Now, there are a number of trading strategies. Not all of them will be examined, but you can expect at least one, maybe two questions from this section. It is regularly examined. And you will see that we're initially going to focus on three types of trading strategy, option trading strategy: straddles, strangles, and spreads. Now, both straddles and strangles take a view, or the perpetrators take a view on volatility of the market, not the direction, but the volatility. Whereas spreads, you take a view on the direction of the market, the future direction. Now, we'll look at some examples for each of these strategies using the data you can see in page 2.30. So we've got two options on the Hang Seng Index, one with a strike price of 22,000 points and one with the strike price of 22,400. Now, the call, remember, gives you the right to buy at 22,000, and we're told that the current Hang Seng Index level is 22,100. So if you've got the right to buy at 22,000, when the price is at 22,100, that's attractive. That is why the premium is 150, because 100 of it will be intrinsic value, 50 will be time value. Whereas the put gives you the right to sell at 22,000. Well, you're not going to sell at 22,000. You're not going to exercise when the current level is 22,100. So that 50-point price of the put option is time value. Equally, the 22,400, that one, the call is out the money, so the 30 is pure time value, whereas the put is in the money because you got the right to sell at 22,400 when the current price is 22,100. 300 of that price will be intrinsic value, 30 will be time value. Okay, let's look at the different strategies. As I said, straddles and strangles are where you take a view on the volatility. Now, if you expect volatility to increase, you're going to go a long straddle. And a long straddle is when you invest money, you pay premium, you buy a call, you buy a put at the same strike price. And you're betting that the market is going to move enough that either the call will be exercised or the put will be exercised, thereby making you money. So a long straddle, you're buying a call, you're buying a put, you're investing money, you hope to get a return when the market moves. Whereas the opposite side is where you do not expect the market to move much at all, and that is a short straddle. And a short straddle is where you sell a call and you sell a put. You are gaining income, and you're hoping that those two options are not going to be exercised because you believe the market will be stable. If the market is stable, you pocket the premiums and you make money. So a short straddle is when you're selling something, you've got income, and you hope that the two options are not exercised. Now, strangles are similar to straddles, except the premiums are lower and there is more movement allowed in the market before the options will be exercised. So they will be different strike prices for the two options. Buy a call, you buy a put, and you can see there with the long strangle, you're investing money and you hope that the market will move, but it will have to move by more than it did with the straddle. But you've got a lower premium as a result. Equally, with the short strangle, you are gaining income, you are selling a call, you're selling a put at different strike prices, and the market can move by more, and you still keep your premium, but the premium is not as high as with the straddle. So there's trade-offs between the straddle and the strangle, but both of them are taking a view on the volatility of the market. Spreads, on the other hand, take a view on market direction, whether the market's going to go up or go down. You're happy to cap your profit in return for reduced premium, and you both buy and sell options. Remember, with the first two, the straddle and the strangle, you are buying two options or you are selling two options. Here, you both buy and sell. So you're reducing your overall option cost. Now, there are four types. We've got the call bull spread, the put bear spread, the call bear spread, and the put bull spread. Now, they depend on your view of the market. If it's a bull spread, you expect the market to go up. If it's a bear spread, you expect the market to go down. If it's a call spread, you're buying and selling calls. And if it's a put spread, you're buying and selling puts. So just remember those combinations. And as you will see with the call bull spread, your profit is capped. You gain on the long call, but you lose on the short call. Whereas if the prices fall, you just lose the net premium. If we look at the second spread, the put bear spread, remember, you're expecting the market to go down and you're selling and buying puts. There you can see in the diagram, if the price falls, you'll gain on the long put, but you have a loss on the short put, and that will cap your gain. Whereas if the market rises overall, you lose your net premium. With the call bear spread, you expect the market to go down. And again, if the market goes down, then you gain the premium income because you've sold the puts, I beg your pardon, you've sold the calls. And if the market goes up, you gain on the long call, but you make a loss on the short call. And finally, the put bull spread, remember, you're buying and selling puts and you expect the market to go up. If the market does go up, you gain the premium income. If the market goes down, you gain on the long put, but you have a loss on the short put. Do I need to know all four? I would certainly remember what they mean. The put, you're buying and selling puts. Calls, you're buying and selling calls. The bull, you expect the market to go up. The bear, you expect the market to go down. And then if they ask any question, knowing those concepts, you should be able to navigate the question. Now, other spread strategies, we have the box spread, and that's a combination of a call bull and a put bear spread strategy, and you're looking to make an arbitrage profit. Two butterfly spreads. The long butterfly spread, you buy calls at two strike prices and you expect the market to remain stable. With a short butterfly spread, you sell calls at two strike prices and you expect the market to be volatile. And then finally, the calendar spread. So this is where you're buying and selling options with different expiry dates. With a long calendar spread, you expect the market to be stable. You buy longer term options and sell shorter term options, but they're at the same strike price. And the reverse calendar spread is where you expect volatility. You buy shorter term options, sell longer term options, again at the same strike price. Do I have to remember all the detail of those? I'd certainly be comfortable with the straddle and the strangle and the four different concepts behind the put, bull, put, call, bull, bear spreads. And I'd generally be aware of these spreads I've just looked at, the box, the butterfly, and the calendar. Now, with all the spread trading, there are advantages and disadvantages, and I would be aware of those. Advantages of spread trading, lower cost of trade because you're buying an option, but you're also selling, so you've got income. There's lower overall risk, lower break-even points seen as an advantage. The fluctuation in profit and loss in your positions is reduced, and it can be used to trade volatility in underlying asset prices. Disadvantages of spread trading, higher commission because you're buying and selling all these instruments, and there is, in many cases, limited profit potential. Finishing off the different option strategies, we'll look at 5.4 options with underlying assets. So this is where you hold the assets, the stocks, funds, and you either enhance your income or you protect your position by using options. The covered call, that's where we own stocks and we sell call options. The idea is you're increasing your income and you're taking a view that the prices won't move much. But if the price does go up and the call option is exercised, then you have the underlying assets to sell. So the advantage of a covered call, income enhancement, as I said, lower break-even price because you're bringing in income, and any fall in the stock price will be cushioned by the option income you're bringing in. That's the income enhancement. Disadvantage, though, there is limited profit potential because if the price goes up, the options are exercised, you're going to have to sell the stocks, and so that will limit profit potential. Now, that limit in profit potential of prices going up does not exist with the second one, the protective put. Now, the protective put is where they own the stocks and we're buying puts, and this is like an insurance premium, insurance against the price falling. Because if the price does fall, then you will exercise the put and you'll sell at the strike price. So the overall loss in the position is capped, and with the example we've given you on page 2.41, it's capped at 26. But you still have the upside in the stock. You've not capped it like we did with the covered call strategy. Upside in the price will be still enjoyed. And then finally, the collar. Now, the collar is where we buy puts and sell calls, which is a combination of the covered call and the protective put. And as you will see, the diagram on page 2.42 is similar to the call bull spread. So I would be aware of these different strategies. I would just take short notes to highlight the features of the straddle, the strangle, the four main spread strategies, and the sundry spread strategies that we looked at, and then the three option strategies with underlying assets, the covered call, protective put, and the collar. As I say, they're not all going to be examined, but some of them will. That I can guarantee. As ever, remember, you can practice questions on Examinator.online covering all these different option strategies.